The box truck financial model starts from table of contents. So in the table of contents, you firstly have to enter the company name in here. For example, in here it's Swift Logistics. You could give a different name. For example, if you just type in XYZ Logistics, then across all the tabs, this name will be updated in the specific areas. Secondly, the years of projection. For example, in this case, it's 2025 to 2029. Now let's make it 2024 to 2028. So 2024, 2025, 2026, 2027, and 2028. So if you do that, all the statements across all the tabs are going to be updated automatically, even the dashboard. If you look at the dashboard, as you can see, it has been updated. So let's say in 2024, your revenue in here is 1.5 million. Your gross profit is close to 700,000. Your EBT is this much. So this dashboard basically represents the key financial summaries for each of the different years. For example, in here, the revenue from one-time delivery service is um close to 20 million for 2027. Uh, so as you can see, the revenues from different sources are mentioned. Your investments across different areas are mentioned, and other details are mentioned. I'm going to go through the details later on. This is just to give you a snapshot of the dashboard and the table of contents. So after that, we'll be focusing on the assumptions part. The assumptions part is basically where the real magic happens and where you enter the numbers. Rest of the stuff are basically like reports, which provides the output results of your inputs. Now let's focus on the details and show you how this model works. So the model starts with CapEx and investment assumptions. Now this model was created to help users who are not very comfortable using Excel based models or detailed models. We have tried to make it as easy as possible by limiting the number of inputs, because if we increase the number of inputs, then you will find it more difficult and more complex to use this model. So I'm going to firstly explain how the model works, then I'm going to dive deeper into each of the components in detail so that you can use the model very easily by watching this video. So in short, the model is dependent on your investment, your revenue, and your costs. So firstly, we have divided the investment into equity and loan. So from here, you can adjust the amount of equity you are putting in each of the years. And for the loan, it's only allowed for the initial year. And there is a repayment period and annual interest. Right. So as you adjust this, everything in the model will be adjusted automatically. For example, in here we have invested 350,000. We have taken a loan of 150,000. The loan is for 60 months, which is 5 years, and we are paying an annual interest rate of 4%. Now, as you adjust this, everything other metrics in the model will be adjusted automatically. Now, since this is a box truck business, we have considered that entrepreneurs might opt for three types of trucks. One is large box truck, and one is secondly, we have mid-sized box trucks and small box trucks, or they can have combinations. So let's say for the first year, you are planning to get three box trucks, three large box trucks, three mid-sized ones, and three small ones. You can adjust the prices for each and every type of box truck. For example, for mid-sized truck, it's 28,000. Now, for small trucks, we can make it 20,000. Uh, Underneath, we have the annual capacity per miles per truck. So in order to calculate this, you have to basically use your kind of common sense. So let's say if a truck can operate for like 10-12 hours a day, let's say 10 hours a day, and if you have multiple drivers for each truck, then that the scene is different. But let's consider for example that your truck operates for 10 hours a day and 300 days a year. So 10 into 300, and for each day your truck, or for each hour your truck can operate for or go for maximum let's say 40 miles or 40 kilometers. In here we have miles. If you want to make changes, you can basically make the change in here. So let's say it's 40 kilometers. So in that case, the annual capacity is 120,000 miles for the truck. So this is how you make the adjustments. The amount of the capacity of each of the trucks totally depend on your business model regarding how many drivers you have each for each of the trucks, how much demand you have from the customer side. So all of these factors will go into this. So why does it matter? The reason it matters is if your revenue or if your orders exceed the capacity of the trucks, then it's going to show in the model, which I'm going to come later, which I'm going to come into later. For example, you have a demand for, let's say, 400,000 miles per year from your customers, and your trucks have a capacity, the number of trucks, let's say you have one truck and you only have a capacity of 160,000. So obviously it's not going to be able to meet the demand. So obviously the capacity has to be always greater than the revenue. Otherwise the model is not going to be realistic. So as you can see, we have taken a very rational approach while building this model, and try to avoid any sort of complicated calculations. All the calculations are basically some summation, division, multiplication, this sort of stuff. So as I mentioned, if your revenue assumptions exceed the capacity of your business, so let's say you have large trucks, mid-sized trucks, and small trucks. So the large trucks are meant to serve long haul customers who need long haul services. Mid-sized trucks are for mid haul, and small trucks are for short haul. So the required capacity is 88,000, 262, 800, 3.1. So as you can see, once it reaches 2026, the revenue projection exceeds the capacity for large trucks, which is 800,000. So that's why it is showing as red. That's why when this happens, you have to increase the number of trucks. So let's say I make this 6. So once I make this 6, it's gonna uh, uh, turn into a white background from red. And from 6, I have to turn it to 7. 7 is not enough. I have to make it 8. Even 8 is not enough. So we have 2.9 and our capacity is 1.2. We have to increase this significantly. So 15, not enough. 20, yes. 20, it's gonna work. If I put 20, then it's gonna work. Please keep in mind that you can't just keep on investing on trucks because you have limited funds. So let's say you have $10 and you are planning to invest like $15 on trucks. Then even then the working capital is gonna turn red. So if you have a lack of funds, then it's going to show in the model. So all of these things are very balanced. You can't just keep on investing on trucks. It's going to show you if the funds available, if you have enough funds available for the investment. And you can't just increase sales abnormally. It's also realistic. The sales have to be supported by the number of trucks or the capacity of your existing trucks. So all of these things are very well balanced. Each of these things support each other, making the model very realistic. For example, in case of 20 trucks, if I just put in like 150 trucks or 200 trucks in here, then let's see what happens. So if I put 200 trucks in here, then as you can see, this is going to turn negative because you won't have enough cash to support the investment. So it's going to show up in the model. So the model is going to indicate as you want to increase the revenue. I'm going to come to the revenue assumptions tab in details later on, but the basic thing is as you want to increase your revenue, you have to keep on investing more on capital expenditure, and also in order to get those additional revenues, you have to spend extra on marketing or customer acquisitions. So this is how the whole thing works. I'll discuss this in details. There is also factors of losing customers. A certain percentage of customers will be gone every year. So I'll discuss the details when I come to revenue assumption. So you are investing 500,000 during the first year. Out of that, a certain portion goes to large trucks, certain portion goes to mid-sized trucks and small trucks, and a certain portion goes to these sort of investments. You can adjust these investments based on your need. You can change the investment items in here, and the fee and the values of those investments. Let's say instead of 2,000, if you think that it should be 25,000 realistically, then you can make the adjustments, and everything else, including the working capital and everything. For example, it was earlier 229. Once I increase the investment in here, it has become 206. So everything else in the model will adjust automatically without you having to worry about everything. As you adjust the variables mentioned, also you can only adjust the pink colored, the cream colored background variables. For example, these ones, you can't adjust this variable or this variable. So these are the hard inputs, and the hard inputs are only present in the assumptions tab. So we have 1, 2, 3, 4, 5, 6 assumption tabs. So all the inputs in the model will be through these tabs. You can't make adjustments to other tabs. So let's adjust this also, 20 and 50. Now 20 and 50. So for example, once I put 50, the capacity is 8, but the required capacity is actually for small trucks is 2.4. So I don't basically need so much, so I can reduce. So I can just reduce the capacity. So this is how you can adjust and find out how much should I invest on the trucks and how much should I keep as cash for working capital so that I can run the operation smoothly. So as you can see, the model is not just abstract abstract thing. It helps you identify the different factors in your financials in order to balance and adjust the different metrics to get the optimum result. So I don't need 50 trucks. I can basically reduce the number of trucks to meet the demand for 2.4 million miles. So let's go for 20. Yeah, 20 is fine. I can reduce this even more, like 15. No, 15 isn't gonna work. 18. Yeah, 18 is fine. For this one also, it's too much, I think. I can probably work with 10. Yeah, 1.61. So obviously the capacity has to be higher than your revenue. It is a must. Otherwise, it's not realistic that you have less capacity than revenue. So this is how, as you can see, we can optimize each of the stuff in here. 8 isn't gonna work. It's like 2.4. So let's try 13. Let's try 15. So if you by mistake put something which turns this into a mess, just undo this and it's everything is gonna be all right. So instead of 13, let's try 15. Yeah, 15 is fine. So we have 4.9 and this is like 8. I don't need so much. 25, 30, 34. So this is kind of like a game. You can consider this like a game where you can keep on adjusting the numbers and find out what happens if you do this, what happens if you do that. So this is a very interactive model and dynamic model. Helps you find out what's the best course of action for your business. Now that I've covered the CapEx and investment assumptions tab in detail, I'm going to be moving on to the next tab, which is revenue assumptions. Okay, now let's move on to the revenue assumptions, as I said. So the revenue assumptions is basically dependent on the promotional budget and your pricing and other factors. So I'm going to discuss each of the elements one by one. So firstly, we have the promotional budget. This promotional budget, this part is an assumption. For example, 5%, 2%. So this is an assumption. This is taken as a percentage of working capital. So if you remember the CapEx, we made an investment and we had to invest on certain items. After the investment, the remaining amount goes to working capital, and out of that working capital you have to pay your salaries, you have to pay your marketing budget and day-to-day operations expenses. So from that budget we have allocated a certain amount for promotional budget, which is 5% or $10,000. Out of that, we have certain promotional channels. Now, realistically, you might not use all of these channels. You might only use 2 or 3, in most cases, 4 channels. Initially, you might only use one channel, which is totally fine. In that case, what you have to do is, let's say you only use in-person marketing. Let's say you only use in-person marketing and you don't need any of these other channels. Then you can just make the promotional proportion of total budget to 0. Just make this 0. Make this 0, 0, 0, 0, 0, 0, 0, 0, 0, and 0. So as you can see, this has become negative. This has become red. The reason is it has to be equal to 100%, because obviously if you are investing 10,000, if you are putting 10,000 in promotional budget, all of the 10,000 has to go somewhere. So as I have removed the allocation for the other channels, I have to increase the allocation for this channel, which is in-person marketing. So let's make this 100%. So once I make this 100%, it's gonna go back to normal. But as you can see, this has become negative. This has become negative. The reason is your CAC for in-person marketing is very high, which is 450, which shows that the projection does not support the uh, the projection does not support the model. Uh, the reason is, let's say if you are investing 450 to acquire one customer, and if you are losing, here is churn rate, which is 2% per monthly. So 2 into 12 is 12. 2 into 12 is 24%. So 24% of your acquired customers are leaving you. So based on this and based on the high CAC, the model is not going to be sustainable. That's why this has become negative. The cash flow will go into negative. So if I go to the cash flow, I'll come to the cash flow later on. I'm just going to show you. So as you can see, this has become negative, which means the business is not sustainable. So let's take this back, because if you realize, this is in other cases we have 150, 250, 75, 10. So based on this stuff, if your CAC is very high and if you are just relying on that particular promotional channel, then the business will not be sustainable. So if the business doesn't support the projection, then it's going to show in the model, as I just mentioned. Now the Okay, now the acquisition cost for in-person could be lower. If you wanted to make it lower, like instead of 450, let me show you again. So now I have removed everything. So let's lower the CAC. So instead of 450, let's make it 150. Now let's see what happens. Even then the business isn't that sustainable. Let's make it 50. Now the business is sustainable. So the model is also going to show you at what customer acquisition cost your business becomes sustainable. So this is very interesting. Let's get back to normal. Power off. So I just did this to show you the different tactics to play with the numbers in the model. There's also a place for adjusting the number of customers acquired manually. Let's say you know someone and you acquire them and you don't have to spend any marketing budget for them. In that case, you can just adjust in here. For example, let's say you know 10 people who are going to come to you for availing services, then you can just enter 10 here. Obviously this doesn't have a cost, so as you increase this particular section, number of organic customers acquired, these customers do not require any marketing or promotion to be acquired. It can be your friends, your family, people you know. So you don't have to spend any marketing budget to acquire these customers. So you can adjust this manually if you want. It totally depends on you. Also, the monthly churn rate, if you think it's higher, then you can adjust this. If you think that it should be lower, then you can adjust this to like 1%. It will also impact your revenue and other factors, because if you lose less customers, for example, if it's 2%, then as you can see it's 307. If it's 1%, then it's 328. So as you can see, you can your cash flow increases, your profits increase, and everything else increases. So all of these factors come into play. So as I mentioned, this is a very realistic model. If you change one element of the model, then other stuff will also change. So let's say we acquire 3 customers from this channel, 9 customers from this channel, and the summation of all the customers that are added in here is like 243. So let's say for the first year we acquire 243 customers. I'm gonna explain how this is gonna affect the revenue and how the revenue calculations are gonna work. But before that, let's dive into the revenue assumptions part. Then I'm gonna move on to the revenue breakdown part. Okay, now let's discuss the revenue assumptions. So now that you have acquired 243 customers during the first year through marketing and other efforts, all of the 243 customers are not gonna take one service. They might take one service based on your business model. That's a different issue. But let's say you have three different sort of service, three, four different sort of service, three being the core services. The three core services are one-time delivery service, then contractual delivery service and special delivery service. So based on your business model, you could only offer one-time delivery services, or you can by one-time delivery service, what we mean is customers who are only taking your services on a one-to-one basis, on a one-time basis. They don't have a contract with you, they don't have a long-term contract with you. Those customers are going to be different from customers who have a long-term contract. So we have divided this into one-time delivery services, contractual delivery services, and by special delivery service, what we mean is that there might be customers who are willing to pay higher fees or higher prices for faster deliveries for more fragile items. So these sort of categories we have considered into special delivery services. So based on your business model, you could offer 0% to contractual delivery service. If you don't have any contractual delivery customers, you can make it 0% percentage of total customers acquired. If you think that it should be higher, then adjust this. Similarly, if you think that you will only offer one-time delivery, then you can adjust this accordingly. And also you can adjust the special delivery services based on this. So the summation has to be equal to 100%. That's how it basically works. And within each of these revenue sources, within each of these three revenue sources, we have long haul, mid haul, and short haul. I already mentioned before that long haul is provided by the large trucks, mid haul by the mid-sized trucks, and the short haul by smaller trucks based on common sense. So we have the prices based on price per mile, percentage of delivery. So let's say we, out of the 243 customers, 60% goes to one-time delivery service. And out of that 60%, 20% goes to long haul, 40% goes to mid haul, and 40% goes to short haul. So this 100% represents the summation of these three. And at the end, there is another summation, which is going to be the summation of the special delivery, contractual, and one-time delivery. It has to be equal to 100%. So this is how the whole thing is designed. If any of the stuff doesn't fit into the puzzle, then it's going to show in the model. And that means that the model is not realistic and you need to make adjustments. If you think that the price is lower or higher, then please make the adjustments accordingly, as I mentioned. Also, there is a thing about average monthly mileage per customer. So for long haul, based on this assumption, it's 200. If you think that it should be higher or lower, it totally depends on your business case. Because each business is completely different from other business. So if you think that the average monthly mileage per customer should be higher or lower, please adjust accordingly. Then the whole model is going to change based on your assumptions. Then we have advertising on box trucks. There are some box truck owners who provide advertisements like billboards, like moving billboards on their box trucks. So you have the chance of making some money from there as well. So this is based on simple assumption. So let's say we have 25 customers for this sort of services, and they pay 250 on an average. So based on this, you have an extra source of income. So this is how the whole revenue assumption is designed. Now I'm going to be moving on to the revenue breakdown part. So let's move to the revenue breakdown. I can just click here and move to revenue breakdown. So the revenue breakdown is for 5 years, and it's basically set up in a monthly pattern. As you can see, so we are acquiring 243 customers during the first year, and we have equally distributed the number of customers we will acquire throughout the months, throughout the 12 months, to make it simple and easy to understand. So for example, we're in January, and in January we acquire 20 customers. And if we deduct the number of customers that we are losing, then we are gonna left with 20 customers. The number of customers we are losing is negligible because you have only a few number of customers during the first month. Let's move on to June. Then it's gonna be easier for you to understand. So in June, we're acquiring 20 customers, but we had 95 customers, accumulated customers that now that have accumulated till May. So till May, we had 95 customers coming from January. So these 95 customers are going to add up with the 20 customers from June, which is going to give us 115 customers. And out of the 115 customers, two customers are going to leave us. and we're going to be left with 113 customers. So this is how the whole thing is designed. uh, then out of the 20 customers, 12 customers are going to go to one-time services, one-time delivery services. 4 are going to go to contractual, 4 are going to go to special delivery. So this is how this is designed. Out of this 12, 2 will take long haul, 5 will take mid haul, and 5 will take short haul. All these numbers are based on the assumptions that I just showed you earlier. So based on that, we just multiply with the prices in order to get the revenues for each of the years. You can minimize this, collapse this in order to see the summary like this. So this is how the whole thing is designed. The revenue breakdown is designed. The revenue breakdown, after the revenue breakdown, the numbers are taken to the revenue summary for easy understanding. Then from the revenue summary, you have to visit the income statement. So the revenues that we just calculated so far are going to be taken into income statement, and from there are other stuff that we will discuss later, like cost of services, operating expenses, which I'm going to come into later. Okay, now we have the cost of services assumption, which involves fuel cost, driver costs, and other costs that you want to add. It could be parking charges or other maintenance costs or other costs you want to add. These are based on per mile basis. For example, for fuel, we have considered this to be $0.4 per mile. If you think that this should be higher or lower, then please make adjustments based on the requirements of your truck. So let's say if you have a truck which consumes $0.4 dollars worth of fuel per mile, then just adjust this in the model. This totally depends on your realistic scenarios. Wages as well, for wages as well, if it takes longer for your trucks to travel per mile, then adjust this particular area accordingly, because for drivers we have considered this to be hourly wage. So if your drivers have to spend more time per mile, then obviously it will impact the cost. Also, the hourly wage can be adjusted from 25 to, let's say, 35, 40, 20, 15, whatever your number is, you can adjust this accordingly. So this is how the whole thing is designed. For you can make the adjustments for each of the sections. So as you can see, if you make the adjustments in here, it's going to impact the income statement, the cash flows, and everything. Then we have the operating expenses and other stuff. So if I just go to table of contents, we have costs assumptions, which is cost of service assumptions. Then we have operating expense and taxes. So in operating expense, there are two elements that are not present in here. One of the element is your promotional budget, which has already been covered in the revenue assumptions, and we have the salaries, which is going to be covered later. So in operating expenses, you could have maintenance, repairs, uniform, fleet management software, this sort of stuff. So you can make the adjustment for the numbers in this particular section. For taxes, if you're paying 2% tax, then uh, just mention 2% tax. If you are paying 20% tax, then please mention this number in here. Please keep in mind that if let's go to income statement to show you something. So keep in mind that if, let's say, you are running at a loss, so the tax is charged on earnings before tax, EBT. So let's say if you have a loss in EBT, if this is a negative number, let's just make this negative for the sake of showing a demo, negative 40,000, let's say. So if it becomes negative 40,000, your tax is going to become zero, because you can't have a tax on losses. So the model makes sure that the numbers are adjusted in a proper way. Apart from that, we have the salaries, which is covered in this area. So in salaries, as you can see, for example, for the business owner, you are gonna get 2,000 per month for the first month. These are very hypothetical figures, so if you think that this should be 5,000 or 10,000, please adjust accordingly. Also, there is a provision for annual increase. So if you think that annually the way the salary increase should be 5% or 10%, then please mention this in here. Let's say 5%, then it's going to adjust accordingly. Let's say for driver coordinator, you need 3 driver coordinators for 2025, then you can just adjust in here, and everything will be adjusted accordingly. So this is how the model is designed. You can make the adjustments, but it doesn't involve so many variables, which makes you overwhelmed. So It has a lot of details, but it doesn't make the model complicated. If you just go through the model and go through this video 1 or 2 times, then you will find it very easy to use the model. So we have already covered most of the sections: capex assumptions, revenue assumptions, costs, opex assumption, salaries assumption. I'm going to cover the cash flow assumption later, once I cover the income statement, balance sheet, and other stuff. uh, so this is cost of service breakdown. I covered cost of service assumptions earlier. Cost of service breakdown is very similar to your revenue breakdown. We have a monthly breakdown of the costs and how the revenue impacts the costs. Basically, the difference between cost of service and operating expense is that cost of service involves those costs which change with revenue, which are variable cost. For example, fuel cost. Fuel cost, you will only incur fuel cost if you are serving a customer. If your trucks are sitting idle, then you won't incur fuel cost. But let's say office rent. So it's a fixed cost. So it's part of operating expense. Even if your business has zero revenue, you will have to pay your office rent. So this is the basic difference between the two. That's why we differentiate, we put them in separate tabs. So there's a detailed breakdown of these costs in here. Everything, them you might these things might seem like a lot of numbers, but if you just go through the details and the structure, it will seem very easy for you. This is simple multiplication, division kind of stuff. There's nothing complicated in here. So then we have the COGS summary to make it look easier. Then we have the operating expenses. Then the income statement, which involves the revenue, cost of services, and the operating expenses. So you generate revenue. That revenue creates profit. That profit goes to your cash flow. And from that cash flow, let's say here it's the net profit. So from that cash flow, we have to adjust for depreciation, because depreciation is a non-cash expense. So if I want to explain this in details, let's go to table of contents and non-current asset schedule. So the depreciation is calculated in this particular tab. So what this is basically, let's say if you are buying a large box truck, the box truck will have a certain lifeline. Maybe it will last for 10 years, maybe it will last for 5 years or 20 years, depending on the brand and everything. You have a limited lifetime for that particular truck. So this is adjusted in this particular area. If I go back to the capex assumptions part, why has this become negative? 4.9 and 5. I think I have to increase this a bit. I made some changes here and there, that's why this is changed. So as I mentioned, if you make changes here and there, it's going to impact the whole model. Anyways, coming back to this, so in here, as you can see, useful lifespan in years is 10 years. So if you think that this should be 20 years, then just insert that 20 years. So the value is 105,000, and if it has a lifespan of 10 years, then each year you will be losing 105,000 divided by 10, which is around 10,500 will be lost per year on the trucks. It will be gone, because after 10 years you will have to basically throw that truck out. Realistically, you usually salvage that, but we are not going to go into that complication. For after 10 years, we are going to consider that it has no value. So based on that, if I have to run it for 10 years, then let's get back to the non-current assets part. So non-current asset schedule. So as you can see, the depreciation is 10,500 because it has a lifeline of 10 years. And after that, after the end of the first year, your value for the large truck is 94,500. So these are the depreciation cost, but this 10,500 is not going out of your pocket. That's why this is a non-cash expense. That's why when I go to the cash flow statement, so when I visit the cash flow statement, as you can see, the depreciation is added back into the profit because it was deducted in here in this region. I'm not going to go into the complication of the calculations. You don't have to learn all the complications. It's totally fine if you don't want to go into the details, but just to show you the inner mechanisms of the whole model. I'm explaining this. So after adding this, we have to adjust for the payables. So payables, receivables, and inventory has to be adjusted. After that, we have the operating cash flow. Then from the operating cash flow, we have to deduct the investing activities cash flow. So these are the cash outs that we have invested on the capital expenditure, like trucks and other capex items. And from that, we have to also add the investments, which involves equity, loan, and also the loan repayment issue comes into this particular model. For example, for the first year, we'll be repaying 30,000. For loan repayment, we have a separate detailed tab in here, which involves how we're going to pay the loan, how much principal we're going to pay. For example, for the first year, for the first year, for the $150,000 worth of loan, we'll be repaying for the first month. Sorry, for the first month, 2,500 will be going towards the principal payment and 500 for interest payment. As we progress further, the interest payment is gonna drop, but the principal payment is gonna remain same. That's how the calculation has been adjusted. The interest payment goes down because the remaining principal goes down from 150,000. By the end of January, it's 147. By February, it's 145. It's 142. So you will be able to see how the loan is decreased over the months for the 5-year term. So this is how it works. Now, regarding the cash flow assumptions, I wanted to discuss this later. So let's discuss it. So we have the assumptions for payables, receivables, and inventory. So for payables, we are only considering salaries payables. For receivables, we are considering this to be 1 month, and for inventory as well, 1 month. So if your receivables and inventory increases, then it impacts your cash flow negatively. And if your payables increase, payables is basically loan, short-term loan. You can consider that as short-term loan. And receivables are basically the opposite of loans. You are giving loan to other people. That's how it works. And inventory, you understand inventory, it's part of stock. So inventory and receivables will eat up your cash, and payables will supply you with cash. So increasing payables is good for cash flow, and it will increase your loan, but it's good for cash flow. And increasing receivables and inventory will lower your cash flow. So this is how it works. Then after adjusting everything, we have the cash balances for each of the years. These compiling all of this together, we have the balance sheet in here, which compiles the capex items, the current assets, which involves inventory, cash flow, which we just got from the cash flow statement in here. Then we have the receivables, the liabilities, the equities, everything. We have the balance sheet. The balance sheet has to match. If it doesn't match, then it's going to show in here. There will be a different number apart from zero. In addition to this, we also have burn rate analysis, complete burn rate analysis. So if you remember the dashboard in here, there is another graph which is showing the burn rate. So this is showing the cash balance for the each of the months for the 5 years. So initially it's going to be low, but as the business does well, in fact it can be negative sometimes. If it goes to negative, it means that you need to inject more cash, otherwise the business won't be sustainable. You will run out of cash. So there are two aspects to a business. If you have a profitable business, but if you don't have cash flow, then you have to close the business in the short term, even though the business might be profitable. The other thing is your business might be doing well for now, and you might have cash flow for now because you have investments and you have cash balance. But if your business is not doing well in terms of profits, if your business is running in losses, then in the long term you have to close your business. So income statement affects the long term, or profits affect long term business sustainability, and cash flow impact short term business sustainability. So in order to indicate the cash flow of the business on a monthly basis, we have this particular graph, and this graph has been extracted from the burn rate analysis basically. So if I go to the burn rate, analysis, it's going to show me how I'm burning the cash and in which areas I'm having to invest the funds. For example, for the first month, January, we have 27,000 revenue. This much from payables. As I mentioned, payables increases cash flow, so it's part of cash in. We have cash coming from equity investment and loan. So we have a cash in of 527,000, and we have a cash out of 82,000. But please keep in mind that this is just the initial month of the business. That's why you have these two large figures. From the second month, you will start getting a more realistic figure. For example, for this from February, you have revenue of 47,000, and you have around 47,000 of cash in, and you have a cash out of 94,000, which is pretty normal. During the initial stages of the business, you will be burning cash. So this is how it is represented in here, and the cash balance will decrease, initially. And as you can see, it is decreasing initially, but over time, if your business does well, then it will start increasing. Then we have the valuation. So in valuation, the valuation is basically based on certain factors. I'm not going into details. NPV is net present value. So the based on these assumptions, the value of the business is around 280 million. Please keep this in mind that all the figures in here are kind of hypothetical, and as you change the numbers in here based on your realistic scenarios, the valuation will also change.